Please stay tuned for important disclosure information at the conclusion of this episode.
This is Destination Retirement with Robert Kuhn from Kuhn Capital Partners. When a part of your financial strategy is out of tune, your long-term goals, your retirement savings, and your legacy can all suffer. With many years of experience in the financial industry, Robert provides his clients and prospects the information they need regarding Social Security, retirement income planning, wealth management, and much more. Listen in as we address your financial concerns and provide helpful strategies to put you on the path to achieving your retirement goals. And now here is Destination Retirement with Robert Kuhn.
Welcome, welcome, welcome. You're listening to Destination Retirement. My name is Robert Kuhn. I'm the president and founder of Kuhn Capital Partners. We're an independent registered investment advisory firm. And yes, we are a fiduciary. We embrace uncertainty. We think that to be successful in retirement, especially in these markets, investors must incorporate uncertainty planning when it comes to asset allocation and portfolio construction, which I think will have a great opportunity to increase your returns while reducing risk, but more importantly, certainly help you overcome the shortcomings of traditional portfolio methods. So with that being said, if this is your first time listening to the show, welcome. Hopefully you find our educational bias to be a positive one. Everything we do is to help you understand the financial markets. And if we can help you answer any questions that you may have, we're certainly there to do it. If you're a listener that has listened a time or two, welcome back. As you know, we do podcast every episode at kuhncp.com. kuhncp.com. Go to the radio tab and you can listen to all of our shows. I'd love to see the podcast downloads going up and to the right. I think that means we're doing something right. So thank you. And if you want to have a conversation with myself this week about anything investment related, again, we believe in a data-driven process. We think that's the best approach to portfolio construction. Our job, my job, is to identify what your biggest risks are and make sure that we're actively managing and, if possible, hedging against those risks. That's what makes a good advisor. So give Paige a call, 630-492-1912, 630-492-1912. Let's have a conversation this week. So, I start every episode by saying a lot's going on in the market, and that is no different this time. Obviously, a lot of investors are concerned. We're having a lot of great conversations. I'm amazed how many people still just have a buy and hold strategy, a buy and hold philosophy, no matter what the markets do. And I'm here to tell you that's best for the advisor. It's not best long-term for you. And an advisor, I understand why they do it because I am an advisor. I own an advisory firm. We have financial advisors, and it's because it's easier to run the business. And it's very challenging to make changes on a minute's notice or a week's notice or a month's notice for 200, 500, 1,000 clients. And so that is why you constantly get this buy and hold approach, because there isn't good enough software to be able to, because everybody's different, right? And not one strategy is appropriate for everybody. And there's no great software that I've come across that allows you to actively manage different risk levels. And that's why you get this buy and hold philosophy. And when you have a buy and hold philosophy, you're simply at the mercy of the markets. You can't, that's it. You're not controlling anything. You're at the mercy of the markets. And let's look at where we're at today. The complete opposite from where we were from 2009 to 2021. The complete opposite. When you have professional advisors getting frustrated on TV on the range-bound market that we're in, it's challenging. And here's what's even more challenging. It's probably not changing. The Fed is going higher. The Fed is staying higher longer. Just look at inflation. It's not going anywhere. And when you get the 10-year up to 4 or 5, 6% potentially, which is a risk-free investment, what does it do to equities? Right? Why would you take a lot of equity risk in an uncertain market if you can get a short, 10 years isn't a short-term treasury, but I mean, heck, the 2-year today is paying, 5.25. So we're in a period of time that the traditional approach to asset management, I believe it always puts you at a disadvantage, but it 100%, in my opinion, puts you at a significant disadvantage over the next year, 2 or 3. You have to have growth, right? We have to have growth, but it has to be forward-looking growth. You have to look at growth where you buy names that are on sale, and then when they don't become on sale, you sell. Then you buy names that are on sale. You rinse, you repeat, you rinse, and you repeat. You have to have protection. Protection strategies are huge, whether it's protected income or whether it's protected growth. Protected growth, we're still at 15%. And what that means is there are strategies that exist that can provide you the first 15% currently, at least for the next year, of the S&P 500. So you get from 0 to 15, you get it. Anything above 15, you don't get. On the downside, your worst year is 0. Think about that. Your gains are locked in each year, and you never have to play that catch-up game. Your principal's protected. I mean, it's just a very strong strategy to recoup the losses that people lost in bonds. So we have to look at the world differently. And the opportunistic growth, we have a fund. The fund can go long. The fund can go short. The fund can hedge. The fund can be momentum based. The fund can take short-term trades. It can take long-term trades. It's 100% unconstrained. It's a phenomenal strategy that provides maximum flexibility in a market that changes by the minute. So you either get on board or you're at the mercy of just going up a little, going down a little, going up a little, going down a little. And we're seeing people get very frustrated on TV live. So a lot going on. And, the markets, obviously, inflation came in hot and the markets acted accordingly. But our job on the radio show is to put you in the best position to succeed. Any advisor's job should be to identify your greatest risks and make sure that you're actively managing those risks or hedging those risks away to the greatest of your ability. So, a lot of research out there. And when we look at those that are within 5 to 10 years from retirement and those that are within retirement, I want to spend some time going over the wild cards of retirement. I think we need to address the retirement worries of clients and of what investors are feeling. I think, many people may believe they're on the right track for a successful retirement, yet they don't know what their margin of safety is inside of their portfolio. You can't tell me that you're on the right track if you can then not tell me that I know what my margin of safety is inside of my portfolio. I mean, these are things that you don't need to think of from 2009 to 2021 when the market's up 13 to 16% a year. Inflation is non-existent. Stimulus is plenty. Interest rates are 0. I mean, it's the exact opposite today. I mean, you know that. So we need to know what the margin of safety is. And regardless of your wealth, again, as you know, as a firm, we have clients that have net worths of 40, 50, 60 million. And we have clients who have $100,000 to $200,000 of investable assets, and that's it. Our job is to help everybody, and we're very passionate about that. So yes, regardless of your wealth, you may be worried about market volatility, rising inflation, generally, and higher healthcare costs, especially healthcare costs. I mean, those are just some of the wild cards of retirement that we're facing. And when you look at the biggest risks based upon the studies that individuals are feeling, it's certainly market risk. Look at the market volatility. Retirees ranked market volatility as their top risk, and that was according to a survey cited in Barron's. And this risk generally refers to the potential for sudden and large drops in the stock market, which can significantly decrease the value of your portfolio and threaten your financial security. I mean, that's what volatility is. It's here. It's present. It's real. And my question is, how are you hedging against that volatility? How are you taking advantage of that volatility? Anybody can make you money from 09 to 21. No advisor is a superstar because the market did everything. But yet we're still seeing clients sit with advisors that meet with them twice a year, that have a buy and hold philosophy, that tell clients that they can't play defense, that it's time in the market, not timing the market. And you just have to sit and take it. Take it good or take it when it's bad. And I'd ask, well, who is that benefiting? You or me? It's great for you. You manage $100 million, $200 million, $300 million. Everybody can do the math. Making 1% on that money. Life is good, right? For the advisor, it's good. And then they convince you why nobody else can play defense. That's garbage, because the good advisors can play defense. Doesn't mean we're getting in at the bottom, out at the top. I mean, that's crazy. But it means you can play defense. It means you can actually hedge against market risks. It means you could have protection strategies in place. So I understand volatility. I think there's a lot of money to be made in volatility. I think bear markets can make you rich. You just don't know it during that time. But unfortunately, if you're doing the same old thing that benefits the advisor more than it benefits you, it's time to wake up. And it's time to learn that there's other ways to manage money. So my question to you, it's a real simple litmus test. If you have $100,000 and you're invested in mutual funds or ETFs, why? Why? Mutual funds are not customizable. They're not transparent. They're not cost effective. And they're certainly not tax efficient. So there's a better way. And we want to share that way with you. You look at our equity strategies. I mean, of the 5 that we use, 2 are in the top 1%. The other 3 are in the top 5% of all asset managers. And that goes back a long way. Individual stocks, you have your own cost basis. We know exactly what you own. There's maximum transparency, maximum customization. So 630-492-1912, 630-492-1912. Call Paige. Paige will set a time for us to talk this week. 630-492-1912. So market volatility certainly is one. Sequence of return risk, it's something we don't talk about a lot on the radio. I think it's hard to articulate it on the radio and for investors to get a picture of it, but it's actually very, very simple. Sequence of return risk, this is the risk that can impact retirees who need to withdraw money from their portfolios to fund their retirement, especially early in retirement. If a retiree experiences a significant market drawdown early in retirement while also needing to withdraw money from their portfolio, they truly run the risk of depleting their savings faster than if they had experienced the downturn later in retirement. That's what sequence of return risk is. Where are we at in the market today? I think the probability of flat to down or low growth is far greater than us going into another 2009 to 2021, where we see 13 to 16% rates of return. So sequence of return risk is real, and you can insure against it. There are so many strategies that give guaranteed income, and not only guaranteed income, but guaranteed income that has the opportunity to increase to keep up with inflation. And the more money you have, the more I see investors utilize those strategies because they recognize the value of guaranteed income that can increase. And hopefully you deplete that asset because you're still getting that income till the day you die, no matter what, even if the account goes to zero. And then what that allows you to do is I think it truly frees up the rest of your money for pure growth or opportunistic growth or alternatives. So we'll talk about alternatives in a minute when we get back, and then we'll go back into the retirement wildcard once we get back. But you're listening to Destination Retirement. My name is Robert Kuhn. Thank you for listening. Please give Paige a call this week. We can have a conversation no matter what it is. If it's investment related, we can try to help you to the best of our abilities. 630-492-1912, 630-492-1912. More after the break.
Hoping is good. Knowing is better. You are unique, and your investments and plans should reflect that. Investors today want defined outcomes, not investments that simply track the stock market up and down. Did you know most of all mutual funds and managed accounts by prospectus must stay fully invested no matter how good or bad the stock market is? There is a better way. We want our clients to use portfolio gains to compound their investments, not make up for portfolio losses. Schedule a complimentary call with Robert. With Kuhn Capital Partners, partnership isn't just a promise, it's in our name.
Welcome back. You're listening to Destination Retirements. My name is Robert Kuhn. Thank you for listening. Kuhn Capital Partners, we are an independent registered investment advisory firm. We are fiduciary. We embrace uncertainty planning. We want to incorporate uncertainty planning in our asset allocation and portfolio construction. We believe that will help overcome the shortcomings of traditional portfolio methods. Hopefully you recognized in years like last year what those shortcomings are. I think our job is to identify what your biggest risks are and actively manage and hedge against those risks. Our goal is to pursue a better outcome for our clients. When the markets are down, we want to lose less. We believe you can be both a bull and a bear at the same time, and I think that is our greatest strength. Our job is to protect and then grow. I think beyond investing, a good financial advisory firm takes a holistic approach to investors' financial situation. I think we always lead with goals-based financial planning, and that's our job. So if you allow us to help you, we certainly will do that. If you'd like to reach out to Paige this week, you can give her a call today. She'll answer and schedule a time for us to talk. 630-492-1912, 630-492-1912, or visit the website kuhncp.com, kuhncp.com. So the wild cards of retirement. We talked about the first wild card, which was certainly a concern. And market volatility obviously is a big concern. It's not going anywhere. I think it's going to become more present. I think when you hear people on TV talk about the algorithms and what that means and what's going on, I think algorithms are controlling the markets, and I think they're taking advantages of short-term dislocation and pricing. And I think those who are losing are those that don't have strategies that can take advantage of that. Those that only have buy and hold strategies, I think you're going to be at a significant disadvantage going forward. So concentration risk, that's another risk that we see. So when we look at, concentration risk, I think retirees who have a significant portion of their portfolio invested in a very, single asset class or asset class or two, I think you're vulnerable to concentration risk. I think this risk is probably one of the greatest risks. It refers to the potential for a decline in value of a particular sector, and you could see significant decrease in value of your overall portfolio. When we look at concentration risk, a lot of people will immediately think I own one or two stocks and that's it. I'm here to tell you that I think probably 95% of investors listening today actually have significant concentration risk because you own two asset classes generally. You own stocks and you own bonds. So you own equities and you own bonds. But you might say, well, you're wrong because I own small cap, mid cap, large cap, international, emerging markets. Well, okay, fine. It's still an equity. So it's still going to move in tandem with the broader markets. So you really own one asset class. Well, then if you have bonds, then you own two asset classes, and that's it. That to me is concentration risk. That's why in years like last year, when the equities were down 20% and your fixed income was down 15 to 30%, you lost so much money. And that's a big concern. And it should be a big concern to you because proper asset allocation, proper diversification is owning strategies that can act in, deliver, whether good or bad, independent of the stock market. If you have more than $2 million of investable assets, 2.2 to be precise, we have some phenomenal alternative strategies for you. Strategies that act independent of the stock and bond market. 30, 40, 50% of endowments, pension funds, the high net worth allocate their strategies to private equity like strategies. Yet the $2 to $10 million client has very little. So if you have over $2.2 million, because that's what the SEC requires, then you have access to new strategies that are not just stocks and bonds. And you should give us a call because we'd like to introduce you to some of them, because not only are they a great diversifier, they're a potentially significant revenue generator if the markets stay flat or down. So if you have $2.2 million and you want to learn about alternative type strategies, give us a call, 630-492-1912, 630-492-1912, and we'll certainly share a couple of the strategies that we see that are adding significant value to clients' portfolios. Inflation risk, I think that's front and center in everybody's mind. When you look at inflation risk, I think retirees who rely on fixed income investments such as bonds or CDs, they may be particularly vulnerable to inflation risk. As you know, inflation certainly erodes the purchasing power of money over time. I think that's pretty basic stuff, but it can reduce the value of retirees' portfolios and decrease their ability to maintain their standard of living. And that is a real problem today. Inflation. What is your goal to combat inflation? How have you adjusted your retirement income strategy, whether you're taking money today or you're taking money in the future? What have you done differently? Have you done anything differently? Or are you comfortable with, seeing your purchasing power erode by half? Because that certainly is a possibility over the next 3 to 5 to 7 years. And I think when you look at what inflation has done, it's added a layer of complexity and concern that hasn't been there. Many investors who are in or near retirement just haven't seen a whole lot of inflation. I mean, it was deflation for the longest time. And I think when you look at clients, they're really, really concerned by it. And, I think when you look at retirement income planning, I think it has to be a priority for you to know exactly how you're going to get your cash flow in retirement. Is it going to be, how are we going to do it? What's the best way to get the most guaranteed income that can provide me with potential raises every year? Is it leveraging an insurance company? What I have found is the more money you have, the more value you see in setting aside some money that you can't outlive. That's going to be there no matter what. And that has freed up other assets to really go after, just kind of pure growth. So what have you done? What's your income maximization plan due to what is happening in inflation? Inflation keeps going up. I mean, now we're looking at, who knows, right? I mean, when we talk about landings, it's like no landing, maybe medium hard landing or a soft landing. I don't even know what that means anymore. All I know is that the Fed is telling us what they're going to do and they keep doing it. And then everybody on TV comes and says why the Fed is going to balk and they're going to make changes. Well, they haven't done it yet. So what have you done when we trade in such a thinly traded market range? What have you done to adjust to that? What has your advisor done to adjust to that? Are they doing anything to adjust to that? And unfortunately, most aren't. They're collecting their fee and that's it. And I think that's just not good enough today, because if we're talking about the wild cards of retirement, which is market volatility, sequence of return risk, concentration risk, inflation risk, there are people that are worrying about those wild cards. We've seen surveys that have said 51% said they're extremely or very confident about enjoying a comfortable retirement, but anxiety lurks not far below the surface. And the two chief causes of unease are inflation and rising healthcare cost. Think about that. Two of the top wild cards factors in retirement are inflation and healthcare cost. 70% of those surveyed in a recent study said that inflation and rising healthcare costs or in rising cost of living represent their biggest financial risk in retirement. I think the biggest financial risk, like we talked about last week, is longevity. I mean, what are you going to do if you are living 20 to 30 years in retirement and we see, more significant downturns? So, everybody should be concerned about retirement income and spending because there's a mismatch right now. And when you look at, studies that indicate a mixed picture regarding income and spending, many are taking active steps to ensure adequate retirement income, but some people have a very distorted view about spending. And, that's a big concern of mine is if we see the market that goes down, what are you going to do? I mean, if the markets go down 3 or 4 or 5 years in a row, or you see a big 2008 again, which I don't think is likely, or what if we don't see any meaningful growth for 3 to 5 to 7 to 10 years? If you're in a buy and hold strategy, what does that do to the longevity of your assets? If you're in retirement, what does that do? What does inflation do? If you're 10 to 15 years from retirement, you still need that money to grow. So if you have 100,000 or $1 million or 5 million or 10 million, you may need to see that money grow by 30 to 50% total over the next 3 to 5 to 7 years. But what if we're in a period of, slow growth and, limited upside on the market? As you know, if you'd bought Microsoft in 2000, it took you 16 years to get back to even. So those are the things that we're having conversations with our clients, with potential investors that are not certain that they have the right strategy in place. And if that is you, just give Paige a call, 630-492-1912, 630-492-1912. She'll set a time for us to talk this week. But we would certainly love to, answer any questions that you may have. I know it seems like we're talking a lot about inflation today, but those are real issues that everybody is facing currently, and it's not something that's even up for discussion. You just see inflation. You can't minimize inflation. Inflation can have such a negative impact on an investment portfolio that I just think it's my job to really share with you kind of the things that we have to guard against. And yes, with inflation, the number one issue that most people recognize is reduced purchasing power. Yes, inflation takes the rise in the price of goods and services, which in turn reduces your purchasing power of dollars, right? Your dollar doesn't go as far. And that means over time, the same amount of money can buy fewer goods and services, which can truly hurt the value of your investment portfolio. I think most people understand that. Do you have a retirement income strategy or plan that can adjust for that can go up each year, that can potentially increase in guaranteed payments each year? So those are the things that we have to sit and think about and talk about with investors, especially in this market. One impact, the negative impact of inflation, I don't think many people have a good grasp on, is the lower real returns. Inflation can erode the real returns of investments. For example, it's simple math, but for example, if an investment earns a 5% nominal return, but inflation is 3%, the real return is only 2%. So look at the risk that you're taking to get that. So if inflation is higher than the nominal return, the return can become negative, which means that investors are actually losing purchasing power over time. So if you look at, a lot of people will say, well, I just want a 2-year treasury, 5%. Okay, fine. But I mean, if inflation is 5 or 6 or 7, well, your real rate of return is negative. So we have to deal in reality. And I don't see people adjusting their real rate of return for inflation, or the return rather for inflation, which will give you the real rate of return. And then lastly, the impact on companies. I don't think that people fully understand how devastating inflation can be on companies as well. I think inflation can also impact companies in which an investor holds certainly stock in. When prices rise, input costs can go up and revenues and profits can go down. this can lead to a slowdown in the economy until stability returns. And so, yes, I think it's going to be here for much longer. And just look at what interest rates are doing. But my question to you is, what have you done? So we want to make sure that you're giving yourselves, your portfolio, the best chance to succeed. We've talked about a lot of the risks today. We call them the retirement wildcards. And let's have a conversation with how we're hedging against those. To me, that's the job of an advisor. So when we get back, we'll go over more. 630-492-1912. Give Paige a call today, 630-492-1912. Set a time to chat this week. More after the break.
Are you considering buying an annuity? Or did you buy an annuity because you were promised stock market-like returns with no downside? If you own the wrong annuity, there is a great chance you've experienced little to no growth over the past few years. In many instances, the insurance agent received more in commission than many have in actual investment growth. If you'd like to learn more about our annuity repair strategy, please call Robert, 800-674-3217. Again, that's 800-674-3217. With Kuhn Capital Partners, partnership isn't just a promise, it's in our name.
Welcome back. You're listening to Destination Retirement. My name is Robert Kuhn of Kuhn Capital Partners. We're independent. We're a registered investment advisory firm. And yes, we are a fiduciary. Our job, as we always say, is to identify your biggest risks and make sure to the best of our ability that we are hedging against those risks, because those risks could prevent you from achieving whatever goals it is that you have. And so I think that's the job of an advisor. The job of an advisor isn't to handhold you and tell you that things are going to be okay during markets like we've been experiencing over the last 2 weeks. You need action. You need an advisor that's proactive. You need an advisor that understands that active management is needed sometimes. And if you believe in that buy and hold strategy, and if your advisor never makes changes and never is proactive with raising cash and playing defense, it's time to fire them. And it's time to go manage the money on your own, find a new advisor, or go and talk with Schwab, Fidelity, or Vanguard if you think that ultimately that's the best way to manage your money. We believe in active management, especially if you have over $100,000. So if you believe in active management, you want proactive hedges in place inside of your portfolio, and you want to work with an advisory firm that is not only a fiduciary, but believes in active management, believes in trying to identify your greatest risk in retirement, even if you're 10 years from retirement or if you're in retirement, then we're going to be a good group to talk to. So you can call Paige, 630-492-1912, 630-492-1912. So a couple talked a lot about, obviously, the market and a lot of the risk that, we're still now going through. And I just can't believe that we're, reading headlines again, so reminiscent of 2008. I was talking with a money manager, this week, and he said, "Were you around in 2008? And I'm like, "Oh man, I'm getting old for this business," right? I mean, I was around for, 96, 97 long-term capital and the devaluation of the Russian currency. And so there's been so much, but, it never is different this time. I mean, the reality is, risk happens fast, contagion happens fast, and it's happening faster than we could have ever imagined. You can wire out, just look at what happened with Silicon Valley Bank and, in those banks that were, that certainly was, a bank that was affected in First Republic. I have a fund and oddly enough, last week we signed DocuSign new accounts there, and now clearly we're not we're still in the decision-making process of what we're going to do, but risk happens, and risk happens fast. And I think what we talked about towards the latter part of the last segment is we believe in portfolio construction. We believe that you have to have protected income or protected growth. You have to have growth, and you have to have opportunistic growth. So the protected income side, I think there's a level of peace and just comfort knowing that no matter what your income needs are met, that you should take some money and utilize a strategy that can in addition to your other guaranteed sources of income, Social Security, pension, etc., can guarantee the income that you need. And it's a very simplistic strategy. These are not, and the banks and insurance companies both have variations of these strategies. And so it's not like, we're sitting here saying you have to go with one or other, because there's pros and cons to both. I think it's the job of an advisor to craft a portfolio that, is going to suit your needs the best. And it may be the insurance strategy, it may be the bank strategy, but if you have that peace of mind of knowing that your cash flow needs are met, then what's that worth to you? I mean, what is that worth to you? It's like I look at and I talk with a lot of my friends, I'm 48 years old, and, the bulk of my friends are somewhere in my, where I'm at currently age wise. And it's like, what's an extra whatever dollar it is? Do you really want to make an extra $50,000, $100,000, $300,000 a year? Or do you want to, spend that time with your family, or spend that time doing things that you enjoy? And a lot of times, again, it's just that peace of mind, right? Well, the market could shut down, and somebody in their 40s and even, early 50s, we can reinvent ourselves. I mean, let's just say hypothetically, they say no more advisors. I mean, clearly, I don't think that would be the case, but I guess nothing would surprise me in this world anymore. But, as of tomorrow, there's no more advisors. Okay, fine. You got to manage some money on your own. Well, I can go and reinvent myself and figure out, how I can do something that helps people, or figure out a way to make money for my family, right? But what about that person that's 5 years from retirement, or that investor that's in retirement, or, in the second half of retirement? What do you do? What do you do if you see your portfolio go down 20, 30, 40%? And it just amazes me how people don't have an income strategy in place. So many people are using just reverse dollar cost averaging. You're just taking money out of your portfolio to live on. And, you look at the probability analysis, and an advisor may sit down and say, listen, 90% of the time you were perfectly fine. Well, what about the other 10%? I mean, it happens. And if you've learned anything, me over the last 25 years, but especially, just going back to 2000 and the whole COVID mess. And then here we are, already, in 2023, and we're dealing with bank issues again. I mean, so if you've learned anything, it's those anomalies exist, right? So if you don't have a guaranteed source of income, and again, it doesn't matter if it's insurance or if it's the bank strategy. Now, if you have 5 million, 7 million, 10 million, 15 million, you're going to use those strategies a little bit more opportunistically than a client who may have 100,000 or 500,000 or 1 or 2 million, right? But if you should have that, because that will free up capital to take advantage of, chaos in the market. Because I've heard it all the time. I want to wait till the market goes up to make me feel good to get back on the market. Well, I mean, yes, as a human, that makes all the sense in the world. As an advisor, it's the dumbest thing I've ever heard, because what makes you feel comfortable, right? The market going up. Well, then you're missing 5%, 10%, 15% of the gains. But again, I understand that. And yes, the human side of me makes complete sense. But what if you didn't have to make those decisions? What if you had a strategy in place that already planned for that? I mean, just basic putting stops in. One of our portfolio managers that we utilize, they got stopped out of a lot of positions this week. And so now they're heavily cash. That's a beautiful thing. What does that mean? That means when you buy an investment, you have a predetermined level that you're out, no matter what. No questions asked, no thinking. If I like it, if I buy something at, hypothetically at 30, and for whatever reason it drops to 25, you're out. I mean, just out. And those are the types of strategies that's a very basic way to manage risk. Is you have equities that have predefined stops in place, and you're able to then take the emotion out. And what's the worst thing that could happen? You miss a little upside. Big deal, right? I mean, absolutely big deal. And the investing philosophy that I've always subscribed to is you never go broke taking a profit, ever. But yet when you look at Wall Street and you look at retail financial advisors, they'll tell you when to buy something all the time. They'll never tell you when to sell something. I mean, it's like, that to me, anybody can tell you when to buy something. It's the ability to sell at predetermined times, whether it's on the upside or the downside, that makes you have a great strategy. You look at these investments, and when you go into an investment, at some point, the investment is either going to go up or it's going to go down. So the risk reward characteristics of that strategy, of that investment, are going to change. So if I put money in a stock at 10 and it goes to 20, well, do I ring the register? Did the risk profile change? Do I at least take off my initial investment so we're playing with house's money? I mean, what's the philosophy there? Well, the philosophy is, you buy and hold it, and you don't have an advisor because he's got, they have, 1,000 or 500 or whatever accounts, and they don't subscribe to active management. So they're not, set up to run model portfolios and take profit. When they take one, they take it for everybody that's in that portfolio. So what inevitably happens is you see on paper, you made a lot of money, but then markets like this week happen and you give it all back. And that has to feel worse, in my opinion, than losing money, because you had the money, but yet you didn't have an advisor that paid enough attention to detail, that just simply subscribed to buy and hold. And here's what buy and hold is. Again, 70 to 80% of the time, it's fantastic. But here's why I say that it benefits the advisor always. Because they're out getting new clients. They're out raising new money so they can charge a fee. So their revenue goes up. Their personal revenue goes up. And that, unfortunately, once the industry switched from commissions to fees, it became a challenge, because you used to be able to market somebody's ability to give you good advice immediately. If I call you and say, hey, we're going to buy this, we're going to sell that, or we're going to sell this, and we're going to buy that. Well, you knew that the next time I called you, you're going to ask for an accounting of, hey, how'd that last trade go? Well, if I keep giving you bad trades and you keep losing money, chances are you're probably going to stop taking my advice, right? But once the industry went to fees, well, now all of a sudden, the buy and hold philosophy came in. Just buy, you can never play defense, Mr. Advisor, Mrs. Client. Even though Wall Street does it with their own money, the advisor probably does it with his or her own money and family money and whatnot. But when it comes to you, we're just going to tell you to buy and hold, sit and take it. Don't worry about banks failing. Don't worry about losing 30%. Don't worry about missing out on tremendous opportunity to make money, because I'm too busy trying to find my next client. So, that's unfortunately an oversimplification of what I think is happening in the industry. And I just wonder at what point do clients or investors recognize that that's just not good enough. So you're listening to Destination Retirement. If you want to have a conversation with me this week, please do that. You can call Paige at 630-492-1912, 630-492-1912. She'll set some time for us to have that initial call next week. More after the break.
Would you like your portfolio to be more certain in uncertain times? These days, there are more questions than ever. Before we can get to the answers, we have a question for you. What do you want to accomplish? Understanding the bigger picture is the first step to helping you pursue your goals today, tomorrow, and for generations to come. To schedule a complimentary call with Robert, please call 800-674-3217. Again, that's 800-674-3217. With Kuhn Capital Partners, partnership isn't just a promise, it's in our name.
Welcome back. You're listening to Destination Retirement. My name is Robert Kuhn. I'm the president, founder, and portfolio manager of Kuhn Capital Partners. We're independent. We're a registered investment advisory firm. And yes, we are a fiduciary. Everything we do is to try and provide good outcomes, lose less when the markets are down. And if you've heard anything this show, and I probably am repeating myself a whole lot when I listen back to this show, it's probably going to drive me crazy. But that's okay, because I know that people don't listen from start to finish unless you're one of the 700-800 people that download the podcast each week. And we want to get that to 1,000. We want to get that to 15,000 and 2,000. And that ultimately is my goal. But, so I'm probably repeating myself, and I'm not going to apologize about it this week, because I think it's a job of myself, a professional who is on the radio, who's giving investment advice, that, we just give you, ways to cope through, these types of markets. And so if you want to have a conversation with me this week, give Paige a call, 630-492-1912, 630-492-1912. And again, I want to thank everybody for everybody who reaches out. It's not lost on me that I don't know you, and certainly you don't know me. And yes, I do the radio show, so maybe you listen a bunch and you kind of know my personality and whatnot. But it takes some courage to make a call to somebody and ask for help, especially if you're already working with a current advisor. And I would say 8 out of 10 of our clients are coming from people who already have existing advisors in place. The other, 2 out of 10, and that's just kind of random. I think that's probably pretty close, but obviously I don't have the exact statistics, but they're managing the money on their own. And I think when they see these shocks in the market, they've started to say, hey, I'm really smart. I own this, or I do this, but my expertise is not managing money. And so those investors are coming to us as well. So we've talked a lot again, on protection this, week, and we talked about hedging, and we've talked about, just looking at, basic risk management. And, unfortunately, this business, I think, is very simplistic. I truly do. I think many advisors are full of themselves, and they can't articulate complex topics, so they talk over clients, and they don't listen to clients, and they just want to hear themselves talk. And, they just want to be the smartest people in the room. Well, the reality is that, just look and see, were you buying investments, inside of your portfolio over the last week or two? Ask an advisor what the hedge is inside of your portfolio. And there are hedges today in the marketplace that can guarantee income, that can guarantee principal. Insurance companies have them. Banks have them. I mean, there's a 2-year bank note from JP Morgan that I'm going to be plus or minus here on the percentages, but it's a 2-year bank note, 100% principal guaranteed. And over the 2-year period, you got a max gain of 18%. I mean, think about that. So if you break that, some people say, so I'm getting 9% a year. Well, maybe, but you get your total gain is 18% over 2 years. And it's principal protected. This one happened to be a JP Morgan banknote. As long as JP Morgan is still in business, then that banknote is guaranteed. Why aren't we having these types of conversations? Why are we not talking to investors about protecting, losing less, and then being opportunistic with a chunk of money? My favorite asset class, if you look at, obviously financial planning is key. Financial planning is really, when you reach out to us, generally what we'll do is talk about income. What are you trying to solve for? Why are you investing to begin with? Now, of course, we know why ultimately, but we want to know what your why is. Is it to maximize income? Is it to turn $1 into $10? Or is it to keep that dollar at $1 and just produce income for the rest of your life? So we want to know what your goal is and what you're hoping to accomplish. And generally, what we'll figure out first is if you're in retirement, we're going to talk about income maximization. We're going to look at your income streams. Are you dollar cost averaging out of your portfolio? And that's a very dangerous game to play when the markets are down. Or do you have guaranteed sources of income? And we're going to analyze those, and we're going to make sure that you have the best strategies in place. If you're not in retirement and you have 5 years, 7 years, 10 years, 15 years left to retirement, well, we're going to basically take your resources, what you think your goals are in retirement, and we're going to see if you're on track. And if you're on track, fantastic. If you're not on track, well, then we're going to have conversations. We're going to have conversations either or regardless. But the job that I want to know is, what are you trying to accomplish? And then the next question I'm going to try to determine. It's not going to ask you directly. I mean, I may ask you, but you may not have a good answer for it. But what is your hedges? What are your hedges in place to protect you from not experiencing or meeting that goal? And in that, to me, is so critical. So many people came on CNBC this week when we were talking about the market. It just became a, kind of a right to make 15 to 20%, over the last, from 2009 to 2021. It kind of reminds me back to, the dot-coms where, in the late 90s, I had clients, were up 25%. Well, what'd we do wrong? It's like, we have to check ourselves here, right? And so we want to make sure that, we're putting in place the appropriate strategies to take advantage of and not be controlled by volatility. So yes, we have the protected bucket, protected income. We have clients that want to guarantee all their income. Okay, fine. There's great strategies, certainly some trade-offs if that's what you want to do, but it gives you that peace of mind, right? What's that worth to you? The growth bucket is very, very fun. If I look at kind of what bucket I like to manage the most, it's the opportunistic bucket. Easily, hands down, because that opportunistic bucket is a bucket that's unconstrained, can go anywhere. If you have under 2.2 million, we have to do it outside of our fund, which is fine. That's not a big deal. If you have either $1 million with our firm or you have a net worth, not including your house, of greater than 2.2 million, then we can put it in the fund. And those are just, that's where in my opinion, significant money can be made. And you look at the characteristics of kind of how we manage money in that opportunistic bucket. The characteristics of what we like to do are, excel or exceed in these types of markets. And to me, we're going to see these types of markets. These may be the norm. Now, maybe not banks failing, right? But, again, I didn't get back to something. I love it when I'm doing the show and I was trying to make a point. I forget the point and I go on to my next point, and then I remember what the point I was trying to make. I'm going to go back to that point because it was very important. We could see, it became a God-given right to make 15, 16, 17%. I was listening to a couple people on CNBC this week, and they said, well, when I got in the business, the Dow was at X, and it took 16 years for us to see any meaningful growth. So for those people that think that can't happen again, you're wrong. And I don't want that to happen again, but wouldn't you rather have an advisor that could manage through that and still make money during that period? Because if you have a buy and hold strategy, like I've said a million times on the radio show, you bought Microsoft in 2000. It took you 16 years to get back to even. 16 years. Yet they tripled, quadrupled their earnings during that period of time. There was significant money to be made. But if you had a buy and hold strategy, you made no money for 16 years. And here's the reality. You don't need to have a ton of money. If you have $100,000, I think we can really help you. And you have $1 million, $5 million, $10 million, $15 million, $20 million. Well, certainly we can help you. The more money you have, the more access you have to strategies. But I love working with that $50,000, $100,000, $150,000, $300,000 client just as much as I like working with the $5, $10, $15, $20 million net worth clients, because our job is, no matter what you have, we consider you to be rich. Seriously, you have $100,000? Well, you're rich. It doesn't matter what somebody else has. That's what you got. And so we have to protect, we have to grow. And you look at inflation, are we in a stagflation environment? Well, it's starting to look more and more like that. Maybe that would be a good thing, right? I'd much rather be in that type of a market where we're still growing, but we're not, overcoming inflation rather than the market's going down 20 or 30%. But, if you have cash in the portfolio, and that leads me kind of that opportunistic bucket, there's times you can make money, and there's a lot of money to be made in bear markets. So I talked quick this week. I apologize if I kind of lost my train of thought, over, some periods, but this was kind of a shoot from the hip episode, because I'm tired of people losing money unnecessarily. I'm tired of people working with lazy advisors. I'm tired of people working with advisors that are not providing the true risk management ultimately that they thought that they had, but they don't have, because markets can go three ways. They can go up, they can go down, and they can go sideways. Most people listening are going to make money in an up market. Most people are going to lose money in a down market. And I don't know what is going to happen in a sideways market. Most people aren't going to make any money. There's money to be made in all three markets. That's why you have to have a philosophy, a strategy that has a protected strategy, a growth strategy, and an opportunistic strategy. So with that said, if you want to have a conversation this week, even if you reached out in the past and we never connected, no worries. We still want to talk with you. Give Paige a call, 630-492-1912, 630-492-1912. She'll set a time for us to have a conversation this week. More next week.
Thank you for listening to Destination Retirement. Don't pay too much for taxes or retire without a sound retirement plan. For more information, please contact Robert Kuhn from Kuhn Capital Partners. Call 630-492-1912 or visit them online at kuhncp.com.
This recording is for informational purposes only and should not be considered investment advice. Kuhn Capital Partners does not provide legal, accounting, or tax advice. Any statement regarding such matters is explanatory and may not be relied upon as definitive advice. Opinions expressed are current as of the date of this recording, and such opinions are subject to change. The views and opinions of guests on this program are not necessarily those of Kuhn Capital Partners. Any reference to guarantees, principal or income, protection, buffers, or defined outcome investments are generally structured notes or fixed insurance products backed by the claims-paying ability of the offering company and are not insured by any government agency. Kuhn Capital Partners is not affiliated with any guests unless otherwise stated and does not guarantee the accuracy or the completeness of any data presented. Kuhn Capital Partners and its affiliates are not responsible for any trading decisions, damages, or other losses resulting from or related to the information, data analysis, or opinions in this recording. Past performance is not a guarantee of future results. All investments are subject to investment risk, including but not limited to the potential loss of principal. Advisory services are offered through Kuhn Capital Partners, LLC, a registered investment advisor.